please welcome to the stage Ian Wennick, Jennifer Grancio, and Allison Bonds-Mazza.
Good afternoon. First, I want to thank all of you sincerely for joining us at 3:20 p.m. when the bar is literally right over there. So, thank you. So, by way of a very brief introduction, I am Ian Wennick. I am the editor of CityWire RIA, which is a website which covers the wealth management industry. And the best part about my job is that I get to ask people a lot smarter than me to explain concepts that I don't know, and then it's my job to try to translate that for the audience at large. So I am neither an advisor or an asset manager. So the first question I'll throw to you guys and give you guys a chance to introduce yourselves is, how has, just generally speaking, the relationship dynamic between the REA community and the asset management industry changed over the last 5 to 6 years, and what factors have driven that change?
Do you want me to start, Allison? Then I'll hand to you.
Yeah.
Okay. So thank you, as you said, to come to our afternoon panel. I'm Jennifer Grancio. I run our global client business at TCW, based down here in LA. Started with active equities, and then a big public and private credit expertise. We think of ourselves as very focused. But to your question, I've been in and around RIAs for over 25 years now. And I think the way I think about RIAs or other independent advisors is like you wake up every Monday and you're doing a couple of different things, right? You're running your own business, so that takes focus. You're thinking about what's in the portfolio construction, that takes focus. And then you're trying to keep track as a business owner and leader, what else is going on, what's new, what do I need to worry about? So I think that's been consistent over the years from an RIA and independent advisor perspective. And I think if you're an RIA, the move to more technology, what do I do with AI, how do I deal with all the private credit, and just this massive continued proliferation of product, it makes it challenging for the RIA. And we can talk more about this, but then as an asset manager, I think it's our job to make sure we know what we're really good at from a strategy and investment perspective. So we're trying to make good use of your time. And then it's kind of our job to support you. So we should understand your business. We should be giving you whatever it is you need. For some people, it's how do you get referrals and build your practice. For other people, it's a portfolio. For other people, it's explaining trends. Like what do you do about the growth in AI? So I think it has gotten harder and more challenging for both sides.
I would agree. Allison Bonds-Mazza, I'm the head of U.S. Wealth for State Street Investment Management. We're a $5+ trillion asset manager, the fourth largest asset manager in the world, and the U.S. Wealth business is about 1.3 trillion of that 5. I totally agree with Jennifer, and I think sort of taking a step back to Ian's question, over the last 5 or 6 years, if we just rewind back to COVID, we were all working from home, and then coming out of working from home, RIAs didn't necessarily come back to the office. And so from an asset manager's perspective, when you all are not in the office as much, or in many cases you've moved, and we're sort of creating these multi-geographical teams and multi-geographical firms, that's a nuance. We have to sort of think differently about how we cover all of you. If the CEO has moved to Florida, the CIO lives in California now, the analyst lives in New York still, and we need to make sure that we're covering all of those different points of influence. Another trend around that, so sort of this, you all aren't in the office, it's harder to meet RIAs in person, we want to meet you where you are, sometimes that's virtual. But another trend on all of that is you don't have a lot of time. And we feel that more than ever, more and more as we talk to RIAs and independent advisors across the country. We hear that because you don't have the time to manage dozens of asset manager relationships, you're really culling your list down to, let's call it 3 to 5. So on one hand, this short list of asset management partners, firms like TCW, firms like State Street, but really looking for firms, if you're only going to partner deeply with 3 to 5, you have to have depth and breadth of product. And so when we hear from RIAs that they're only working with a handful, it's really hard to be on that handful list if you have a narrow product offering, if you're just a parts provider. I don't think you've been able to be a parts provider for a while now, but I think more so now than ever. And so we really see these shifts towards deep partnership, working with fewer but deeper asset management partners, really needing breadth and depth of product, but beyond that, also helping RIAs and independent advisors grow. And we could talk a little bit more about that. One thing that we've done at State Street to try to solve for some of that, And to make sure that we are hitting the mark, we've created a client advisory council. And it's populated with about a dozen of the largest and most influential registered investment advisors in the country. We meet 3 to 4 times a year, and it's really a feedback loop for us, where we listen. What are the greatest challenges you're facing? What problems are your clients having? We're thinking about launching this product. What do you think? What products are you looking for? And that client advisory council, populated by RIAs, has really helped us when we think about our product development strategy, our pricing strategy, what TAMPs or wealth platforms do we invest in to help you all build better portfolios, what resources do we want to bring to bear to help you grow your practice. So there's been a lot going on over the last 5 to 6 years, and it's no longer this like wholesaler calling on a financial advisor relationship. It's much more than that.
So I think that, Allison, you bring up a good point, which is that historically so much of this relationship has been driven by kind of on-the-ground wholesalers, where you say, hey, I'm flying to St. Louis. I'm going to meet with CIOs and reps of 6 different RIAs in the city. But to your point, there's almost a geographic barrier now when you see how some of these businesses have scattered to the wind, or you think about how big some of these firms have gotten, where like a creative planning might be headquartered in Overland Park, but they've got major branch offices all over the place. It can be tough to have that coverage. So geography is obviously one barrier to an effective relationship. What are some of the other barriers, whether that's cultural, speaking the same language, speaking the same kind of language around product? What are some of the other barriers that exist that might create tension in that kind of dynamic between the advisor and manager?
I'll take this one.
Yeah, go for it.
We talked about time. More and more financial advisors, RIAs, have time constraints. We talked about, from an asset manager perspective, we're looking to have access. That's harder than ever. One of the ways that we're really trying to solve for that is creating these deep partnerships where we grow, where an advisor or an RIA grows and we grow. And the way that we think about that is for RIAs that are deeply committed to partnership and deeply committed to growth, we have a VIP client experience offering where if you all are very committed to growing with us, we will throw quite a bit of resources at you. And what I mean by that is we'll send you or members of your team to a master class at some of the most elite universities in the country to help you grow your business or think about your business outside of work. We will bring in growth consultants. We know the number one thing that RIAs are focused on is growing, whether that's through M&A or organic growth. We'll bring in a growth consultant to help you no matter which direction you're looking to do that in. We will bring in a life coach or a performance coach to help you think about how do I get more out of less. Think about teaming, generational wealth transfer. So we've created this program called State Street One. That's this VIP client experience. And it's really for those advisors who are deeply aligned with us, who want to have deep partnership and are committed to growing. And again, it's that whole, if you all grow, we'll grow right along with you. And that's one of the ways that we've tried to kind of eliminate some of these barriers.
And can I ask how many people are sitting here, how many people consider themselves sort of home office of an aggregated RIA? It's okay to raise your hand. I was going to say that I find to this question, I find we have to do both as asset managers. And so part of what we're doing is if RIAs are coming together and getting acquired and getting rolled up, it's created a home office national account concept. People are more likely to be spread geographically all over the place. In addition to that, similar to what you're talking about, it's our job as asset managers to know your business and give you services. And so in some cases, like private credit is a great example. At TCW, we have a big public, we also have a big private credit business. And so one of the ways that we can do value add, as given our business, we don't have some of the other, formal services that you may have. But we're very committed to being an investor-led firm, is we'll work with RIA teams on listen, a lot of people will say to us, we don't get it. It's not entirely clear. I'm not sure how I'm supposed to use large sponsor direct lending, middle market direct lending, and all this new ABF stuff, which we do all of that. And so we'll spend time with you. We'll look at the portfolio. We'll involve our investors. And we think that's part of how we are delivering value or service is in all of these different ways. And for the RIA and independent community, like, you should ask us. We should be staffing the people that manage your accounts. We try to do this at TCW. We have people that, as you said, they're not just wholesalers. They understand your business, they understand the products at a deep level, and they're meant to be resources to you. And it may be a problem or a question in the portfolio about how to add private credit. It may be something else. We're very early investor in artificial intelligence. We do that through an ETF. And so we'll also be asked to come and do a lunch or a dinner, sometimes with a larger RIA, sometimes directly with a set of clients, because that's just a thing that's happening to the world, and that's a way we can add value to your business.
So then just zooming out macro. So look, I mean, I can hop on my phone and I can hop onto my self-directed brokerage app and I can buy a TCW bond fund, or I can buy Spider, one of the select sector ETFs. So ultimately, an RIA kind of functions as an intermediary to the end client. I'm curious because now we have, with the rise of TAMPs, these model marketplaces, investment outsourcing businesses, that's basically an intermediary between you and the RIA. And so I'm curious, just philosophically, how is the rise of the investment outsourcing approach using TAMPs, using third-party prepackaged models as opposed to developing models in-house using your own CIO, how has that kind of changed the dynamic or the relationship you have with some of these RIAs, and what effect has it had on your relationship with the TAMPs or the other outsourcers?
Yeah, I mean, I would say, to give kind of a shorter answer to that, like, it's our job to cover the custodian platform, so the Schwab and the Fidelity, and we have to cover all the TAMPs and all the models, and we have to know them well. And then we're also trying to support you as RIAs, which is part of the getting to know your business, is we then have to know what TAMP you're using and what custody platform you are using. And the rise of TAMPs and models has certainly, been a big factor in the business.
Totally agree. The rise of outsourcing, whether that's through TAMPs or wealth platforms, is one of the major shifts in the industry. And when you have all of these assets flowing through a TAMP or a wealth platform, many of the decisions are made there. And we could have the best solution in the world, but if it's not on the shelf that an RIA is buying from, then it's sort of a moot point. And so we've made a lot of progress over the last couple of years in making sure that our solutions are available on the TAMPs and wealth platforms that you all are using. An example, last year, we announced that we made a strategic investment in Envestnet, which is the largest TAMP in the industry. About $200 billion in assets flow through it. 120,000 advisors use Envestnet, and we're one of 4 premier partners. So what does that mean? It means that we are investing and helping Envestnet with their technology to make it easier for you all to build customized, personalized portfolios for your clients at scale. Another example, in April of this year, we announced that we have a strategic relationship with Ethic. This actually came as a result of a conversation with our Client Advisory Council where they were talking about some of the challenges with some of the wealth platforms that they were utilizing today. And as a result, we partnered with Ethic, again, as a way to enable RIAs to build unified managed accounts with direct indexing and tax overlay all in one place. And if you use State Street products, we subsidize the platform fees for you. So this sort of rise of outsourcing, rise of TAMPs is definitely something that asset managers are navigating. And we've got to make sure that it's sort of the path of least resistance. It's really easy for you all to use our solutions, that we're helping you build better solutions and portfolios for your clients.
So I've come up on the dreaded fee compression question, but I'm going to try to put a little bit of a unique twist on this, which is that obviously we all know that active management is under pressure. There's fee compression across the asset management industry, but RIAs, especially ones that work with the mass affluent client base, are dealing with fee compression, fee pressures of their own. And so when we at Citywire kind of write about this stuff from a practice management perspective, we always try to ask about, what is kind of the core value that you provide that can kind of justify the fee that goes beyond just pure investment management. So to that point, beyond just kind of pure investment management, investment performance, what are kind of some of the other value adds that you guys try to offer to advisors that can kind of get past the fee question and kind of develop an ongoing relationship?
You want to start?
I'll take this one first.
Yeah.
Sure. So the first thing is we talked about some of the resources that we add to really try to justify the fee that we charge, whether that's practice management, portfolio construction, some of the consultants that we talked about, really ways that we try to differentiate ourselves amongst a really crowded space to try to justify the fees that we charge as an asset manager. But the other thing that we do is actually offer low fee products. So again, Jennifer and I have been in and around the RIA space for a really long time. I always say RIAs are not shy when talking about fees. It typically comes up very early. And one of the things that we've tried to do at State Street is continually offer really ultra low cost exposures. And an example of that is our portfolio series ETFs. So we have a range of ultra low cost core exposures. The average expense ratio is 4 basis points. We're seeing really wide adoption of that. I'll give you the best example of it. SPLG, which is the lowest cost S&P 500 ETF in the industry, at 2 basis points. If you think about that for an RIA, typically large cap US is the largest component of a model portfolio. If you can get that from us for 2 basis points, that enables you to use your fee budget for other things. And here we are at this conference. All anybody can talk about is alternatives and privates. Those typically tend to be higher expense ratio products. By offering ultra low cost products for the core part of your exposure, it enables you to free up some fee budget for you to invest in some of those private or other alternative exposures. So those are the things that we're actively trying to do to help make your lives easier. We know you're under fee compression. We're all feeling it. And how do you think about your fee budget as you're building out portfolios?
Yeah, and then what we do at TCW is we know that this is where the industry has gone, so that we know in your portfolios you have low-cost index products. Or I see Doug back there. You have personalized SMA and UMA products from a direct indexing perspective. What we do at TCW is we are active managers, so we need to outperform for you over a cycle. What we do on the equity side is the fees are higher. We come in next to the index products, and we are diversifying. We're giving you the market breadth you do not have right now in the S&P 500. So it's higher fee, but it's a smaller part of your portfolio, and you need to hold us to account on being able to deliver alpha after fees over time. And in the fixed income part of our business, we are active managers. We're value-oriented fixed income active managers. And so the fee is, again, for the performance through time and through cycles, for the ballast it gives you in the portfolio, right? As well as if it's an income product like Flexor, it gives you a return and it gives you an income target. But I think it's the right question. And as you said, Allison, I think RIAs do a good job of working with us when they think the fee is not right. And then we kind of work with them, in a way to make sure we're adding value back to your businesses.
So just in the conversation that you guys have had with RAs on the ground, what types of products have been resonating with them the most recently, and across what kind of asset classes or investing themes have you guys seen the most underlying advisor demand, and why?
Yeah, I'll maybe start on that one. So on the active equity space, if anybody went to the Core Fit workout the last couple days, that's one of our active portfolio managers, Eli Horton, who manages like the future of power and energy, and it's an extremely broad theme. We've been managing that for a number of years, but now it has sort of come into focus on people understand they want to be part of the trend. AI, we hear a lot of people not sure whether to invest in AI in a thematic or to do it as part of the core portfolio. And then, we do private credit. So yes, everybody is talking about that. And I would say we may come back to this. We may have time. I don't think private credit is a fad. I think private credit genuinely adds percentage of outperformance versus the public markets. But it is not liquid. And so I think it's very early in the RIA space for you to all think about. Depending on how high net worth any particular client is, you can add some private ABF and an interval fund. It's semi-liquid. If you really want to notch up to other parts of private credit, they're not that liquid. And people are experimenting with new ways to get access to the space. But that's probably the top topic. A lot of CIOs tell me, why are we all trying to market private credit? And I would say we wouldn't if all the CIOs weren't asking us how do they add private credit to the portfolio. So I think that's a big conversation. People are trying to figure it out.
I think when we talk to advisors around the country, they're thinking about how to build more resilient portfolios. And what I mean by that is the market is hitting new high after new high, and advisors are what I would call uncomfortably bullish. There's a little bit of like a FOMO. I don't want to miss out if the market keeps going, but I'm not so sure that the next market cycle is going to look like the last one, and how do I kind of build resilient portfolios. We see these headlines, and I think they're clickbait. The 60-40 is dead, and I'm not sure about that, but I do know that 2022 showed cracks in the 60-40 and shows what can happen when stocks and bonds are correlated, and particularly on the downside. And so things that are resonating for us around this theme of building more resilient portfolios, building portfolios that can withstand what may come, is the all-weather ETF that we've launched with Bridgewater. 6 months ago, we partnered with Bridgewater to launch All W, and that is what I think it's game-changing, because we're bringing what I think of as the OG or the GOAT of risk parity investing with Bridgewater, a sort of risk parity strategy that for decades has only been available to institutional investors, and now democratizing that and making that available to every investor in an ETF wrapper, and enabling investors to sort of build in that risk parity, that resiliency in portfolios. And we're seeing advisors maybe take a 60-40 portfolio that has now turned into 80-20 and sort of funding that all-weather position by paring back some of the equity exposure and really sort of positioning for what might be to come.
So we've obviously come a long way from just the standard 40 Act mutual fund structure. What are the types of wrappers or product structures that you found have resonated most with advisors recently? And how do you kind of differentiate between the SMA, the UMA, and how do you kind of explain those differences to advisors who might not necessarily fully grasp the differences?
Yeah, I mean, maybe I'll take it from the pooled fund side. So from a mutual funds to ETFs, I think you all know these numbers, but I mean, it's really flipped. So even in fixed income, where it was resistant to ETFs until the last year or two, new money is coming in ETFs. It's not coming in mutual funds. So you see everybody launching ETFs. Share classes are coming. That's tricky. You have to be able to operationally manage moving money between mutual funds and ETFs. It is not straightforward. So the industry hasn't even really started to figure that out. But ETFs have arrived. In the retirement space, it's not mutual funds anymore, it's CITs. So for somebody like TCW, where we have everything from mutual funds to ETFs to separately managed accounts to CITs, we need to provide for you guys the CITs for the retirement accounts and the ETFs in the public space. And then in private credit, you're going to find good managers do many, many vehicles, because different parts of the market are looking for private traditional drawdown versus evergreen series, which is sort of a blend of an evergreen and a drawdown, and evergreen and interval funds. So there's actually a lot of additional structures that you have to sort of understand and ask your managers, make sure your managers are delivering for you. But maybe I'll let you talk about UMAs and the SMAs and UMAs.
Yeah, maybe I'll just put a point on your ETF concept, and just the numbers of it are pretty remarkable. So this year is shaping up again to be another record year for ETF inflows. $820 billion has come into ETFs so far this year. So if you sort of model that out, we're tracking for a $1.3 trillion inflow year for ETFs. That would be a record on the heels of last year, which was a record at $1.1 trillion in inflows for ETFs. And you sort of compare and contrast that to mutual funds, to Jennifer's point. This year, mutual funds are so far negative $400 billion in outflows. And this will be, if that continues at pace, the fourth consecutive year of outflows for mutual funds. So you really do see investors, what do they like? They seem to like ETFs. You sort of see that in the flows, investors and advisors voting with their dollars, and then using ETFs in combination with other vehicles, in ETF models, in UMAs, combined with direct indexing, sometimes with a tax overlay, and then sort of this fifth or sixth generation, including alternatives right alongside it.
So we have just a couple of minutes left, and so we have a couple of audience questions that have come in via Slido. So I'm going to go quasi-rapid fire on these. First one I'll take a shot at. What is the best way to push back if a manager's support feels too sales-driven?
I guess the clever answer would be don't buy from them, buy from a different manager. That gives you a better solution outcome. But I think you should push back if you feel like you're not getting the solution support you need from managers, because we are competing with each other to be able to serve you. So I think you have to push back. I think it's a good question.
How do you see the advisor-asset manager relationship changing over the next 5 to 10 years?
I'll take that one to start. I think we'll continue to see, the growth of outsourcing. I think we'll continue to see centralized decision making, so more and more M&A in the RIA space. You talked about creative planning. That's one of the best examples. But we'll continue to see M&A and sort of this centralization of investment decisions, and a lot of these national or enterprise RIAs looking and feeling a lot like a national account at a home office. And that really changes how we as an asset manager interface, because we've sort of got to take a twofold approach there. We have to call on the home office where a lot of the models are being created and those investment decisions are being made, but also call on the RIAs that are scattered throughout the United States.
So this kind of gets at the fee compression question that we had discussed earlier, and that is, what specific value should an advisor be asking for beyond just pure investment performance?
Yeah, I mean, I would say from a truly active manager, you should be looking for active or getting a good understanding of how the process works and how it's going to work through time. And you should be asking us to help you on portfolio construction, and you should ask us to be helping you on whatever your priority is. Sometimes it's genuinely practice management and supporting me in growth, and sometimes it's more around trends, what's going on in energy and AI, in ways that we can help you with your clients.
I think that's right, and I would ask the asset manager, what do you offer? Because a lot of times, again, I'm sure TCW is the same way. State Street, fourth largest asset manager in the world, running money for many of the largest institutions, foundations, endowments, sovereign wealth funds. In addition, financial advisors, also, end investors. If you want education or thought leadership on something, we probably have it. And for our best, clients who are deeply committed to partnership, we have a slew of offerings that really have nothing to do with investments or performance, but are there to help you build your business. And so I would say, ask the asset manager, what do you offer?
So I've got time for one last question. I'm going to give both of you the floor about a minute and a half each. And that is, what does the portfolio of the future look like, and where do alternatives fit in? So that's private credit, private equity, crypto, hedge funds, and does that allocation, should that get up to 20%, or will it get up to 20%?
Yeah, I mean, I think people have been talking about it getting up to 20% for at least a decade, and it's stuck at 2 to 3%. So let's see. From a portfolio return perspective, if you have an ability to select high quality alts, which that is the first and most important thing, and you should ask every asset manager, you can lose a lot of value in alts if you're not making good decisions. It really makes a difference. So if you can make good decisions, alts add value. My firm view and our view at TCW is most private equity and a lot of private credit, large cap direct lending, it is not hyper liquid. And so your models need to look different for your sort of up and coming lower net worth clients, and they better have a source of liquidity that is not the alts bucket. And as you're moving people into ultra high net worth with less liquidity, that 20% of alts makes a lot of sense. Tax management on putting the private credit into retirement and certain structures so that you can get the income and manage the tax. For sure, money in alts makes sense for people that have liquidity covered somewhere else, and if they understand it.
I feel like this is a little bit of a layup, but I think one of the reasons why alternatives have stayed stubbornly low at 2 to 3% for years, despite everybody saying it should be higher, is because there's been friction around alternatives, and it's been hard to access. You had to have a certain amount of money. There's high minimums. There's lockup periods. There's a lot of paperwork, and so I think the more that alts are democratized, that is going to happen. And I think of a product like All Weather, which getting Bridgewater in an ETF wrapper, anyone can access it. I think that's what investors have been waiting for. And I think that's what can finally take alternative exposures from like that 3 to 4% to higher. And I think that there will be a day, sooner rather than later, that alternatives will no longer be alternative. I think they'll be mainstream. And I see them in everybody's portfolio.
So this is a conversation that took me out of my usual comfort zone, but I had a lot of fun. The lights are flashing red, so they're about to play us off the stage. But thank you guys so much for a really fun discussion. Thank you all for paying attention.